Hello everyone, welcome to my channel. I am Amrita Desai, going to introduce you my first new topic, cost of debt. Here's other point which I'm going to cover. Cost of debt versus APR, how to calculate the cost of debt, example of cost of debt, relevance and use of cost of debt, way of low cost of debt, and conclusion. The cost of debt. There are two types of capital business can be used, that is equity finance and equity. Let's see what is the equity financing. Equity financing is usually a venture capitalist or the angel investor providing working capital in exchange for a percentage of equity or a ownership in a company. Whereas debt equity means a company takes out financing which would be an SBA loan, merchant cash advance, invoice financing, or any other types of financing. The loan is repaid along with an interest expense over the month or year. The term debt equity would be confusing but basically referring to a loan. The cost of debt is a minimum rate of return that debt holder will accept for the risk taken. Cost of debt is an effective interest rate that company pays on its current liability to the creditors and the debt holder. Generally, it is referred to after tax cost of debt. The difference between before tax cost of debt and after tax cost of debt is depended on the fact that interest expenses are deductible. It is integral part of WACC, that is weighted average cost of capital. A cost of capital of company is the sum of the cost of debt plus cost of equity, and the cost of debt is 1 minus tax rate into interest expense. Now we will see the difference between cost of debt versus APR. You may have heard the term APR and think it's the same thing as the cost of debt, but it's not quite. APR or annual percentage rate refers to how much a loan or a business credit card will cost a debt holder over 1 year. The cost of debt refers to the total interest expenses of borrower will pay over the lifetime of the loan. Here we will see how to calculate the cost of debt. Knowing your cost of debt can help you understand what you are paying for the privilege of having last access to the cash. To calculate your total debt cost, add up all the loan balance and on credit card and other financing tools your company has. The calculate to calculate the interest rate expense for each for the year and add those up. Next, divide your total interest by your total debt to get your cost of debt. Now let's understand what is the cost of debt. Here are some examples of the cost of debt. Cost of debt can be calculated in two methods. So first method is simple cost of debt. If you only want to know how you are going to pay the interest, use this simple formula, which is total interest upon total cost equals to total cost of debt. For example, if you are paying a total rupees 30,500 interest across all your loan this year and your total debt is 50,000, your simple cost of debt is 7%. Here they simply calculated total cost interest upon total cost equals to total of debt. So we get the cost of debt, that is 7%. So the second method is complex cost of debt. Let's say you don't care about how your cost of debt changes after tax. So here is a formula to calculate effective interest rate into 1 minus tax rate. A company named ART Private Limited took loan 2 lakhs from a bank at a rate of interest 8% to issue a company bond of rupees 2 lakh based on the loan amount and rate of interest. Interest expense will be 16,000 and the tax rate is 30%. So here the cost of debt is 16,000. So we will calculate the cost of debt is equal to 16,000 into bracket 1 minus 30%. So 30% is our tax rate. So our cost of debt is rupees 60,000 into 0.7%. So a total cost of debt is rupees 11,200. Now we will see the relevance and uses of cost of debt formula. There are multiple uses of cost of debt formula. They are as follow. Cost of debt helps to save the taxes. It also helps to calculate the risk associated with the company. It helps one to calculate net income generated by the company by using loan amount. The cost of debt formula is a component of WACC, that is weighted average cost of capital. Last but not least, one can also calculate after tax cost of debt to know the actual financial position of the company. Ways to low cost of debt. There are many ways to lower the cost of debt. They are as follow. Get cheaper loan. Cheaper loan means to get a loan at a lower rate of interest, which can be done by creating a good credit score, by repaying loan on time, offering collateral, negotiating, etc. Second is refinancing loan. First, one needs to start loan with a rate of interest he is eligible for. Then, when the business starts growing, he can refinance your loan at the lower rate after some month of the loan. Last but not least, optimizing business growth. Optimizing business growth means with an increase of in income of the business, one can avail more debt as he will be able to afford it. The cost of debt is compared with the income generated by loan amounted. So by increasing business income, the cost of debt cost of debt is increasing the amount the cost of debt can reduce. Here is a conclusion of the topic. The firm should consider it the cost of debt and the equity before obtaining fund for the operation for buying an asset. A cost of debt formula is a total tool which helps one to know that loan availed is profitable for the business or not, as we can compare the cost of debt with the income generated by the loan. The amount in the business. The loan can be taken for the multiple reasons, from the issuance of the bond to buying a machinery, prime reasons for it to generate the revenue by the grow business. It also helps to know the cost of capital if a business of the business. The cost of debt formula helps to know the actual cost of debt in the business. It helps to manage should maintain the suitable capital in mix in order to increase the value of firm.